Do you trade just by looking at open interest? If your answer is yes, you could be making one of the biggest mistake in trading because open interest never tells you the market direction by itself. Yet, thousands of beginner traders believe it does. Today, I'll explain open interest in the simplest possible way. Hello everyone, welcome to Now Chart Finance English. In today's video, you will learn what open interest actually means, how it works, why most traders misunderstand it, why trading only with OI can be dangerous, and finally, I'll show you how I personally use open interest in my market analysis. Let's begin. What is open interest? Let's start with the basics. Open interest simply means the total number of active future or option contracts that are still open. In other words, these are positions that haven't been closed yet. Whenever a new buyer and a new seller create a fresh contract, open interest increases. When both parties close that contract, open interest decreases. Remember this, open interest tells you how many positions are open. It does not tell you whether buyers or sellers are winning. That is one of the biggest misconceptions among beginners. Many beginners confuse volume with open interest, but they are completely different. Volume tells us how much trading activity happened. Open interest tells us how many positions are still active. Think of it this way, volume measures today's traffic. Open interest measures how many vehicles are still on the road. Now let's talk about the biggest mistake. Many traders think if open interest increases, the market must go up. That's the completely wrong. Open interest only tells us that new positions are entering in the market. It never tells us whether those positions are bullish or bearish. That's why using open interest alone can lead to bad trading decisions. Let's make it simple. If prices goes up and open interest also increases, there is a possibility new long positions are being created. If prices goes down while open interest increases, new short positions may be entering. If prices goes up while open interest decreases, it could simply be short covering. And if prices goes down while open interest decreases, long positions might be exiting. Notice something I said possibility, not certainty. Because price action always comes first. Imagine Nifty keeps falling while open interest keep increasing. Many beginners think this is a buying opportunity, but in reality, professional traders may simply be adding more short positions. Now imagine the opposite. The market rises while open interest falls. It may not be fresh buying, it could simply be short covering. Without understanding the complete picture, you can easily take the wrong trade. Personally, I never trade using open interest alone. I always combine it with price action, market structure, support and resistance, volume, proper risk management. Only when all these factors agree do I even consider taking a trade. Remember, open interest is just one piece of the puzzle. It is not a buy signal. It's not a sell signal. Successful traders never depend on a single indicator. They build confirmation before raising their money. If you learned something new today, like this video, tell me in the comments, would you like the next video, volume plus open interest? Share this video with someone learning trading. Subscribe to No Chart Finance English because here we don't treat trading as a gambling. We believe in knowledge, discipline, and risk management. No hype, no false promises, just real market education.